Welcome to Escapees Webinars. My name is Georgianne. I'm the Marketing Director for Escapees RV Club. And today we have Tim Ewing here. He is a CPA, Certified Public Accountant, as well as a full-time RVer. And the combination of those two have given him a really unique perspective on how RVers face unique issues when it comes to income tax and traveling and that sort of thing. So Tim, will you take a moment to introduce yourself?
I will. Thanks, Georgianne. Glad to be here. Thanks for the opportunity to share with you and all of our audience out there. I love talking about these things because, as you mentioned, I'm living the life that all of you are, full-time RVing, working full-time. Our youngest son is still with us, so we've got a little bit of family aspect going with my wife and I. And there's some unique challenges, but also, wonderful opportunities that I know you all are dialed into as well. So let's see, just to give you a little bit more background, my wife grew up in Montana. I grew up in Colorado. I actually lived in Arizona during my high school and college years. My family moved down there, and in Tucson, where I went to college, is where I met my wife. And we got married, moved back to Colorado. So all total, I've lived about 30 years in Colorado, but most recently we lived for 10 years in Virginia, near Virginia Beach, and about 30 minutes from the ocean. And so anyway, my wife's parents started RVing there in Montana, and they started RVing full time after my father-in-law retired. And gosh, they've probably been doing it for 8 years or so now. And we started hearing stories about them ending up in Quartzsite, Arizona in the winters. And we were way out east, missing a lot of our family, who's still our parents and our siblings, etc., who are in the West. So we sort of hatched this idea that, hey, maybe we could start RVing full time, not wait until retirement, but that would give us the flexibility to visit our parents. My parents also live in Arizona, so be in Arizona during the winter months, where both sets of our parents are, and then have the flexibility to go back east where our older kids are. We have 4 kids who are out of the nest, and our 15-year-old son is still in the nest. Without spending a bunch of money on plane tickets flying around, we thought, hey, the RVing would be a great way to do it. But the catch was I was a CFO for a nonprofit company, office job, commuted 30 minutes into work every day, 5 days a week. And so how do I transition that to a remote job? And I approached our board of directors to see if they'd be willing to have a remote CFO. They were a little bit old fashioned, didn't like that idea. So I said, okay, plan B is then I want to diminish my role and just be a part-time contractor. I can still add value to the business. I can still provide oversight, leverage all my years of experience. But then that'll allow us to be remote. So that was about a 2-year conversation. And then finally, it was actually about 3 years ago right now, 2014, November, we sold our house in Virginia and sold it on a Friday. We had shopped around and spent the night in a hotel. Saturday morning, we went to the dealership, picked up our 5th wheel trailer. So that timing worked out pretty well, and moved into a nearby RV campground, because at that time I was still commuting into the office. So for our first year and a half being in the trailer, I was still commuting to the office for my job. And we moved around to a few different campgrounds in the Virginia Beach area and northern North Carolina, but we hadn't really hit the road until about 1.5 years ago, when I finally made the switch from full-time employee to part-time contractor. And meanwhile, I'd been putting the word out with just people I'd worked with over the years, was able to pick up a few more clients, doing CPA accounting work for them. And so that sort of gave us some peace of mind to hit the road with some income stream, while giving up paid vacation, paid holidays, health insurance benefits, etc. So anyway, for the last 1.5 years, we've been on the road. So last year was our first winter out in Arizona. Finally got to do that. This past summer we went back east and even worked in a little bit of Montana in between crisscrossing the U.S. So like many of you who are RVing a lot or full time and also trying to figure out how to make a living on the road, I was faced with those same questions and issues from technology and connectivity, but also the accounting aspects. So while I'm helping people with their accounting and taxes, I was needing to figure it out for myself too. Today's topic that we're going to talk about, estimated taxes and the underpayment penalty if you don't pay enough into the IRS, was something I had to figure out. In fact, way back in my college days, I learned an important lesson. I got socked with an underpayment penalty. I had a few odd jobs during the year, didn't have enough taxes withheld, but on April 15th, I paid everything that was due, and was shocked when I got a letter from the IRS saying I was being penalized. I thought, hey, I paid what I owed by April 15th, the due date, so why do I have to pay a penalty? Well, what I learned that day is that our income tax system is a pay-as-you-go system. So not only do you have to pay a certain amount based upon your income, etc., but you have to be paying while you're earning the money. You can't just wait to the end and pay it all in April and not be socked with this underpayment penalty. So, so most of us are familiar with the W-2 employee type situation. It's a, sort of a very fine-tuned system. When you get hired to work for somebody, you fill out a W-4 form, and there's either somebody in HR or payroll staff that helps you through the process. And there's payroll software these days that calculates the tax withholding. You get multiple paychecks throughout the year, so there's a constant feedback of income and how much is being withheld. So that's one of two ways that we pay as we go, is through the withholding as an employee on our paychecks. The second way to pay as you go is the estimated tax. And this is the method for self-employed people. And many of you have heard of paying your quarterly estimated taxes. And we'll talk a little bit more about that as we go. But so with the paying the estimated tax, as I mentioned in my prior experiences being self-employed, I was also a W-2 employee at the same time. So I didn't do estimated taxes back then because I was able to ratchet up my withholding through my paycheck to compensate for that additional income that I was going to be bringing in. And the IRS has some guidelines or rules of thumb, or sometimes they're called safe harbors, that if to determine if you need to do estimated taxes, and I'll throw these numbers out to you in a minute, but as long as you have enough taxes withheld in relation to what your total tax burden was in the prior year, or another test is in relation to what your total tax burden ends up being for the current year. So as long as if you're a W-2 employee and you're having taxes withheld, as long as you meet one of those minimum thresholds, then you don't have to worry about paying the estimated tax. Now, if your only means of income is through self-employment and you don't have any W-2 employee type income, then your only option for pay as you go is to do the estimated tax. And the IRS will say, if you are a W-2 employee and you don't have enough withheld, and you're going to end up owing on April 15th, and you got to send more money into the IRS, they will say if you owe too much at that time, then you should have paid estimated taxes, and they can get you with an underpayment penalty at that point. But generally, if you're planning ahead, you can always ratchet up your withholding and avoid that point. So $1,000 is kind of is the IRS's rule of thumb. If you will be paying more than $1,000 on April 15th, when you file your return, if you still owe $1,000 or more than $1,000 above and beyond what you had withheld, then the IRS is going to say, you should have been doing estimated taxes because that's too much. Now, the safe harbor, though, that can counteract that is your total tax burden. If it's in the prior year, let's just say in the prior year you paid $5,000 in taxes. If your withholding in the current year is $5,000 or more, so it's equal to 100% or more of what you paid last year, then you're safe. Doesn't matter if you still need to pay an additional $1,000 or even more than that. If you paid into the system through withholding at least 100% of your total tax burden for the prior year, then you're okay. Then you won't fall into the category of somebody who should have been paying estimated taxes throughout the year. The other sort of safe harbor is if your withholding in the current year is at least 90% of what the current tax year's tax liability ends up being. That one's a little bit tougher because you don't know what that's going to be. You can project and estimate and work with your accountant to try and figure that out. But the easier way is, if you're in doubt about it, is just to look at on your tax return, what was your total tax due? Now, this isn't the amount that maybe you had to write a check for on April 15th. This is the total tax due before taking into consideration what you had already paid into the system through withholding and or estimated taxes. So again, to answer the question, do I need to pay estimated taxes? If you're in a situation where you have withholding going on, and your withholding is equal to or more than 100% of last year's total tax burden, then you don't have to pay estimated taxes. But let's jump ahead, and I'm going to assume that most of us, or most of our audience watching today, does not have W-2 income or a whole lot of it, enough to where they could withhold enough to offset any self-employment income that they have. So you're in the category of you have to pay estimated taxes, again, to avoid the underpayment penalty. So now the question is, we know we need to pay estimated taxes. The question is, how much do we need to pay to avoid the underpayment penalty? Because it's actually possible to pay more than you end up owing, get a refund when you file your taxes, and still pay an underpayment penalty. Because it all depends on the timing of when you've paid those estimated taxes throughout the year and how much you paid. If you wait and pay it all in the fourth payment period, such that you end up getting a refund because you didn't make a payment due in period 1, 2, and 3 throughout the tax year, that's a situation where you could still be facing an underpayment penalty. So the IRS still uses that same sort of 100% of last year, 90% of this year to determine if you will owe the underpayment penalty or not. But in this case, you're not just looking at, in terms of what you've paid into the system during the tax year in question. Remember, with the question of should I pay estimated taxes or not, we looked at just how much you paid through withholding. That was the deciding factor. If you paid enough into the system as you went throughout the year through withholding, then you knew whether you need to do estimated taxes or not. Now that we're in the category of having to pay estimated taxes, we can look at how much we paid into the system with the combination of withholding and estimated taxes to determine whether we need to pay the underpayment penalty. I hope everybody's heads aren't spinning. 100% of last year's total tax liability, when you sit down at tax time to decide whether you paid enough and if you're subject to the underpayment penalty, one of those safe harbors is if what I paid into the system, if it's a combination of W-2 withholding and estimated taxes or just estimated taxes, if the combination of those two items is more than 100% of my last year's tax burden, then I won't be subject to a underpayment penalty. And then there's the same 90% of this year's income. If my total paying into the system as we went throughout the year exceeds 90% of this year's income, then I'm safe and I won't be subject to an underpayment penalty. Now, one other note about the estimated taxes. Many of you know, as a self-employed person, you not only have to pay income taxes on your income, but you have to pay self-employment tax. And most people may already understand this, but when you are an employee, the self-employment tax is 15.3%. So you have your business has income and deductible business expenses, and you end up with a net income. But in most cases for RVers, that income's gonna pass through and end up on our personal income tax return. And on that business net income, not only do we have to pay the income tax on that amount, but we also have to pay 15.3% self-employment tax. And that's sort of the other side of the coin of the FICA tax. So anyway, as an employee, we're all familiar with the FICA tax. It's a combination of Medicare and Social Security tax. 7.65% of our gross income gets withheld from our paychecks, and the employer matching FICA tax is also 7.65%. So as an employee, the IRS is still getting their 15.3% of gross pay. It's just your employer pays half of it and the employee pays the other half through withholding. But for the self-employed, you get to pay both halves, but they call it self-employment tax in that situation. But it's the same, goes into the same pot as the employee FICA and the employer matching FICA. Okay, so when you're looking at your estimated tax payment and trying to figure out how much do I pay this year, so that next year when I file the return based upon this year's taxes, I'm paying enough into the system and I won't be socked with the underpayment penalty. Not only do you need to keep in mind the income tax on your income, but also this 15.3% self-employment tax on that income. Okay, so now we're in the category of, we know we need to pay estimated taxes, and how much. We talked about one way to determine how much is just to look at what was last year's total tax burden. On your 1040 tax form, it's the line that says total tax. And then below that line is where you deduct any withholding that you've had or any estimated taxes. And then you end up with, okay, do I get a refund or do I still owe more? So again, we're looking at the total tax. The easiest rule of thumb is just your current year's estimated taxes are going to be equal to or more than that total tax from your prior year's tax return. And then divide it by 4. The IRS has 4 payment periods. They're often referred to as quarterly estimated taxes, but they're not straightforward 3-month quarters. And here's a little chart that has the 4, in the middle column, it has the 4 payment due dates: April 15th, June 15th, September 15th, and January 15th of the following year. So the April 15th payment covers your first 3 months of the year, of the tax year. The June 15th payment is payment period number 2, but it really is only covering 2 months, not a full quarter, April and May. Then your September 15th payment period is June, July, August. And then for the final 4 months of the year, September through December, the payment, the estimated tax payment for that period is due January 15th. In this case, it'd be January 15th, 2018, if we're just looking at our current situation. Now on the left-hand column there, what that talks about is if this is your first year in business, you, we don't all generally start our businesses on January 1st. We begin at some point during the middle of the year. So if you began your business, and really what we're talking about now is when did you generate income? Because you can begin your business and start having business expenses that are deductible. And maybe in your first year you have little or no income and you just have a loss that you're going to report. Well, obviously in that case you don't need to worry about estimated taxes. But let's say in July is when you finally start receiving some income from customers, and you project that you're going to get enough income over the course of the remainder of the year that it's going to exceed your expenses and you're going to end up with a net income, a taxable net income. So in that case, the IRS isn't going to penalize you because you didn't make a payment on April 15th or June 15th because you didn't have any income at that point. But once in the period that the income began, so in this example, in July, your first estimated tax payment will be with the September 15th due date. And then again, you want to, I did this for one of my customers who was just transitioning into full-time RVing. He had a little side consulting business going that he had built up while working for his employer. And then a few months ago, he made the switch, left his employer and went full-time self-employed. And we looked at, that was his question, do I need to make estimated tax payments on September 15th was the deadline looming. So of course, it all depends on the projected income. And so we looked at a few different scenarios. But we said, hey, if you project you're going to make X amount of dollars, then what we want to do is pay half your tax obligation on September 15th and pay the other half on January 15th, and you'll be okay not having made payments in those first two periods because your income began in the middle of the year in that third period. So that's if you're beginning your business, your transition year, as I call it. Now let's say you've already made that transition in prior years, and now you're looking at a full year. So of course you've got your 4 payment dates there. You're going to want to, what you're going to want to do is look at your tax burden from the prior year and divide it by 4 and just make your 4 payments that way. Again, that's the easy way to avoid the underpayment penalty. But there's a bit of a catch because the first payment is due April 15th. Many people, many business owners, well, first of all, you have to finish your return so that you know what your total tax due for the prior year is. You have to get that done and know that number before you can divide it by 4 and make your first payment by April 15th. Many business owners extend, take advantage of the automatic 6-month extension. So they're not even really filing until October 15th or close to it. And when you extend, you do some estimates. You still have to pay in whatever might be due. The IRS allows you to extend the filing of your return, but not the due date of when you need to pay your money. But if you sort of do some shortcut estimates and put off filing, again, you're not going to have a real good bead on what is my total tax burden from the prior year. So that's one of the challenges, and that's where it can be helpful to have another set of eyes in there looking. And if anything, just err a little bit on the high side. The IRS loves it if you pay the same amount in each of the 4 payment periods. It makes it less complicated at the end of the year and when it's time to file if you've paid equal amounts and on time throughout those 4 periods. The calculations get a little bit more complex to determine if you're subject to an underpayment or not. They've got 3 different methods for doing the math to determine if you are subject to an underpayment penalty. But if at all possible, get a beat on that prior year tax burden, divide it by 4, and make the same amount of your payment on time. On time is key too. If you don't make them on time, then it's sort of game over. And those safe harbors that we talked about don't apply. Let's see, one more note about that. Let's say you divide it by 4, and throughout the middle of the year, you're making a lot more money and you want to pay a little bit more. That's okay. You know, the IRS will always take more, and you can pay early. They certainly don't have a problem with that. But the key is, you know, if you start paying, let's say you make a $2,000 payment on April 15th, a $2,000 payment June 15th, and then you go down, cash flow is tight or whatever, and you drop down to a $1,000 payment on September 15th, that now puts you in a little different category in terms of that calculation at the end of the year for the underpayment penalty. Makes it a little bit more complicated. Doesn't necessarily mean you'll be socked with the underpayment penalty, but it just means you'll have to do a little bit more work to figure that out. Okay, speaking of the IRS enjoying getting your money early, the one thing they're really good at that I'm impressed at, well, there's probably other things they're good at too, but they make it really easy to pay your taxes these days online. You go online with a few clicks. In fact, so if you go to irs.gov/payments, within a few clicks, they'll verify who you are, usually based upon some prior year tax information. Did you file single or joint? A few of those kind of questions they'll ask you, which is fine in my book, because I want to make sure if I'm going to make a payment, I want to make sure it gets credited to me and not somebody else. So they have some verification questions, and then you just designate whether this is going to be an estimated tax payment or some other type of tax payment. Put in your bank information, and off it goes. You don't have to do any paperwork. You can go online and pay as frequently as you want. But again, the key is when you're thinking in terms of estimated tax payments, you want to make sure that you get those 4 payments in by those 4 deadlines. Also on this screen, I've got the old voucher system. Those are just 2 of the vouchers. Some of you may be familiar with those. So you can always print those out, fill them out, attach a check, snail mail it in. So that's still a viable way to go. But for me anyway, as long as I've got to pay, it's just much easier to go online and do it that way. There's a little caveat I didn't mention at the beginning, is what we're talking about is federal estimated taxes paying into the IRS, the federal tax system. Most states that have income tax have similar rules regarding determining whether you need to pay estimated taxes to the state in addition to the federal government. So in states where you have income, if those are states that have an income tax, make sure you're paying attention to that too, and you're following their guidelines and doing the calculations and paying estimated taxes into the states. And many of them have pretty nice online payment systems too. So they at least make that easy for you. In closing, one more resource, but for those of that you are interested and you're motivated to kind of dive in and do some of this research yourself, publication 505, tax withholding and estimated tax. When you're planning ahead to decide, do I need to pay estimated taxes? And then if the answer to that question is yes, okay, then how much? Publication 505 has a lot of information to step you through those decisions and the things that I covered today. So chapter 2 is where you want to look when you're planning ahead of time, making the decision, do I need to pay estimated taxes or not? Publication 505, chapter 2, and IRS form 1040 ES for estimated, I assume estimated as an estimated tax. But anyway, those forms and instructions will guide you through the process of making the decision, do I need to file or not? Form 1040 ES also has a calculation that answers the question, okay, how much? should I start paying? And again, at this point, this is all planning ahead. So you're projecting income, you're projecting your gross income, your expenses, your net income, and you plug those numbers in following these instructions, and it'll pop out a number that you should be paying for your estimated tax. But you want to pay attention to that as you go throughout the year. If your income starts rising, once you know what your prior year's total tax burden was, you want to make sure you're paying more than that. Especially if your income's rising, to avoid the underpayment penalty. Now the year is over and you're getting ready to prepare your tax return. Publication 505 Chapter 4 and IRS Form 2210 is what you'll use to look backwards and determine, okay, did I pay enough into the system as we went throughout the year to avoid the underpayment? So that brings me to the conclusion of what I've prepared for estimated taxes and how to avoid the underpayment penalty.
And for you guys, we've got a slide here that has Tim's contact information on it. So we've got a question. She says that she has an S Corp and she set up a payroll company to withhold taxes and such in September. She's now sort of a W-2 employee of her S Corp. Will she have a penalty if she does catch up withholding at the end of the year?
Okay, I should just sort of get this caveat out, say it once and for all, so I don't have to repeat myself every time. But the tax code is huge. No human that I know of knows it all and can answer every question. And everybody's situation is so unique. You could have 10 people that are all taking an early withdrawal from a retirement account, but there are other factors in their lives that nuances. You just always want to not just take an answer like I might give you and run with it. You always want to double check, get a second and third opinion, and so on. But and have somebody that you provide those other details of your life and your income and expenses to, so they're seeing the whole picture. Now, okay, so I'll say that, and and I won't bring that up again. But okay, so for this situation, one of the cool things about the W-2 withholding, it can bite you and it can help you, but in this situation, it can help you, is you can have a whole bunch of money withheld from your paychecks at the end of the year. And when the IRS, when you do the calculation, Form 2210, that we talked about earlier, at the end of the year when you're filing to determine if you paid enough and on time throughout the year, the IRS will take your W-2 withholdings and they just divide it by 4 and assume you paid it in 4 chunks throughout the year, even though technically you may have paid it all in December. So I would say definitely take advantage of that sort of benefit of how the IRS treats the withholding tax in terms of its timing, and ramp that up if cash flow allows, and pay as much as you need to through a paycheck. You just gross up your paycheck and you can have all or most of it withheld, so that your net pay is very little or none. But that will get you off the hook of an underpayment penalty. I guess I'll throw this out too, where that approach that the IRS does with withholding can bite you. This was something I had to look into in my transition year in 2016. I was a W-2 employee for half the year. I actually had extra withholding going on because I knew the second half of the year I was going to be self-employed, and the amount that I had withheld through July, when I did my calculation at the end of the year, the IRS spread it out evenly over the year in their calculations. So what I had withheld in period 1 and period 2, some of that got pushed into as if I paid it in period 3 and period 4. And then that, if you're not really watching and kind of planning ahead, that can make it as if you underpaid in period 1 and 2. Because then when you lump in your self-employment income, and I actually had some going on throughout the entire 12 months because I was starting to build up some clients on the side and doing some side work. Um, and I was thinking, oh, my withholding's going to cover it all. But then I realized, oh, wait a minute, half of that withholding's going to make it look like it went into the last half of the year. And I need to make sure that I've been doing some estimated tax payments on top of that, just to, cover myself.
Getting back to some of these other questions, Laura had said that for 2018, they will not be working, but they will be selling their RV or other RV lot and making a profit of about $40,000. Would they pay capital gains or estimated taxes on that?
Yeah, going back to that rule of thumb, there's two ways to pay. First of all, it's a pay-as-you-go system, regardless of your income source. Even if your only income is a nice healthy capital gain.
Okay, so another question we have is from Diane. She says it's the first year on Social Security benefits and receiving IRA payouts. Neither has any withholding. Some W-2 income is still coming in as well. And she thinks that she's okay for this year, but what suggestions do you have for the future?
You just want to look at, Social Security. If you have a certain amount of earned income, W-2 income, in addition to what you receive as Social Security, the IRS will tax your Social Security benefits if you make in excess of certain thresholds. So you got to dive into the IRS rules and regulations and figure out what those thresholds are. But that would be the one thing you want to look for. If you make too much money with your W-2 income, then some of your Social Security income could be subject to income tax. And since you have no withholding going on, that would be a situation where you'd want to look at making estimated tax payments.
A question I have actually, well, I say I have, I've seen many other people ask this just in chat forums and that sort of thing. So thinking about state income tax, you had brought that up briefly earlier on. With state income tax, is it based on your domicile state or is it based on the state in which you were working at that point?
This is one of the most complicated aspects, I think, of doing what we do. RVing full-time, working, just about every day, and then we're in multiple states throughout the year. And so the unfortunate news is, like in my situation, I domiciled in Texas. When we began this journey and did some investigation, I happened upon the escapees and Sean Loring, who's now the CEO, but back then he wasn't, but he's always worked closely with escapees and in fact, escapees recommended I talk to his law firm, Loring and Associates, and they gave me a lot of good information on domicile. So I recommend any of you who have questions about that, talk to Loring and Associates, but they're in Livingston, Texas there.
They're actually inside the escapees headquarters if you ever go through.
Yeah. I had several phone conversations, but actually went and visited that area too. Well, of course, that's our mail address now too. We use your mail forwarding service. But okay, so I'm domiciled in Texas. There's no state income tax, but I have to be careful about which states I'm in and the work I'm doing. Different states have different rules. Some states are more aggressive than others, like California and New York. If you're in California for one day working, they'll say, hey, you owe us income taxes for that day you work. So now there's sort of two aspects of that too. Depending on your business structure, there's your income as an individual, but then if you're, say, an S corp like the other caller, there's kind of the business income aspect of it too. Even though the S corp income passes through and lands on your personal income statement, many states will look at not only whether you as a person were physically present in their state or not, and for how long, but was your business doing activity in there? Do you have an employee? Like I've got a part-time employee in Virginia now. And so I had to look at, okay, I'm away from Virginia. I'm not there for more than 6 months out of any given year. So I'm not subject to their income tax, but now I've got an employee. does that give me, nexus is the fancy word, does that give me enough of a connection to Virginia that, for sure I got to do payroll taxes. I have to do state income tax withholding and unemployment insurance. But what I wanted to know is, does my business, my LLC, does it have an obligation? And states, many states do sort of a three-pronged calculation. They look at whether you have payroll in the state, and for me, with Virginia, the answer is yes. They look at whether you have any property in the state, if you've got inventory stored, if you own or rent space. So if you have some physical property type presence there. And then the third one is sales. And that was a question, like in the case of Virginia, I said, okay, I have a customer. My former employer is a Virginia company, and they're now one of my customers. So does that mean I have Virginia sales even if I didn't have an employee in Virginia and I never set foot in Virginia in a given year? The fact that I have a customer, for the most part, the answer to that question was no. That wasn't enough. But if I'm there personally more than 6 months, and or if I have an employee there, that now pushed me into a category where I have to deal with the income tax side of things with the state of Virginia now. So
looks like Laura has one more question. She says they need to estimate their income because of ACA healthcare. If they are not employed but getting money from investments, how do they do that?
I think what we do there is go to Publication 505, Chapter 2, and the Form 1040 ES. So those are that's where we're going to look when you're planning and trying to make the decision. And it's got worksheets that'll step you through to answer that question: do I need to be paying estimated taxes? So, and in general, I would say yes. If you've got enough investment income throughout the year that you're going to need to pay an income tax on it, if you don't pay income tax, estimated taxes throughout the year, then you'll get hit with that estimated underpayment penalty. By the way, I failed to mention that currently, and it's been this way for a number of years, but the penalty is calculated as 4%. It's a 4% interest. So, and the IRS will look at each of those 4 periods, and the amount that was underpaid by the due date of each of those 4 periods. And so if you underpaid by $500 on the April 15th, they'll look at they'll charge you 4% of that $500 for the time from April 15th to December 31st. And then if you underpaid by $500 on June 15th, they'll look at, between June 15th and December 31st and assess a 4% on that amount. So they kind of take each of those 4 payments, do the 4% calculation, add it all up, and get to your underpayment penalty. Sort of the nerd part of me, sometimes it bothers me that I don't mind doing this, but being able to dive into the tax code, go to irs.gov, read through all the language and try and figure out, get clarity from all this, for better or for worse. I've done a lot of that, and so I'm happy to be able to provide what I've learned, and it helps me be able to do what I'm doing, as an RVer on the road. So.
And so, a quick question from Laura asking if you have appointments available. I'm sure others might have a similar question for you.
Yes, I do. My normal mode is when somebody makes an initial contact is to just do like a free 20-minute-ish conversation, just to kind of get to know their situation, maybe give them a little bit of free advice. And then and then we can take next steps there if they need me to do further research and I don't just do tax type stuff. I do QuickBooks Online, oversee bookkeeping, CFO and accounting manager kind of stuff too for small businesses. So I can help you get organized and generate financial reports and so that when it comes tax time, life is a lot easier because you're more organized. So those are things I can assist with as well.
Well, at this point, it does look like that's all of our questions. So I want to take a moment to, first of all, thank everybody who joined us today. We appreciate you taking an hour out of your morning to sit here and chat with us, and then share your questions with us as well, so we can do some more to help you out. And then also, of course, thank you, Tim, for working with us to put this webinar together and to do this broadcast and take the time to answer these questions. We greatly appreciate you sharing your knowledge and your information with us.
Can I add one thing real quick?
Sure.
I actually have written an article that
Yes.
talks about the estimated taxes, and escapers at some point will be posting that maybe in the next few weeks. So that'll be going up on the website. Also too, I'm out in Quartzsite. I'll be at the Bash in January. So any of you who will be out there, look forward to meeting you and sitting around a campfire and swapping stories. So.
And in case you guys don't know what he's referring to as the Bash, Escapees has a group of members called Escapers that are more of the working on the road type RVer, and they do a big event every year in January in Quartzsite. This year we're calling it the annual Bash because it's different than the normal convergence. And it's a week in Quartzsite and then a week in American Girl Mine that's a little bit further south. And just get together, and like you said, campfires. We do some informal seminars, people that share all kinds of information that they have, and just lots of hanging out and just enjoying each other's company. And so you can look that up on escapers.com, or if you would rather join us instead, or you can do both for the Escapees Happy Hour. I believe it's January 17th out on Plamosa Road in Quartzsite. You can find more about that on escapees.com in our club events calendar. But yes, we'll be out there. So if you're going to be in Quartzsite too, you might as well come by and say hi. And we'll both be there, actually.
Yeah.
I'll be there as well.
Awesome.